Hello, professor and classmates. My name is Oswaldo Robinol, and today we're going to discuss the findings of my research through my paper called Mutual Funds: A Deeper Look. Okay, this was a paper done. Well, research was done for the paper on the mutual funds and the industry as a whole. Okay, and not only that, but I focus mainly on investors and why would they continue to choose mutual funds today before yesterday or after tomorrow. Okay, so first and foremost, what is a mutual fund? Okay, a mutual fund is an SEC Securities and Exchange Commission registered open-end investment company that pools money from many investors and invests the money into stocks, bonds, short-term money market instruments, other assets or securities, and or a combination of all of these. Okay, that is a mutual fund. A mutual fund is basically, in my own words, a company that sells you a share for $35 per se. Every mutual fund that I looked at around had around approximately that price. So imagine you pay them $5,000. Okay, you don't pay them, but you invest that money into that fund. Okay, let's just say it's a growth cap large index fund. Okay, therefore you put $5,000 into that. They're going to take that money that you invested, okay, and they're going to invest it into their large cap growth rate companies, which is stocks or large cap stocks and or growth stocks that are expected to grow tremendously over the next near or long term. Okay, so they will take that money. They pull money from not only you but thousands of other investors. They usually have hundreds of millions or billions of dollars combined. They take that money and they invest it into the large stocks for you. Okay, now this is great because for people like you and I who have full-time jobs, and actually, a lot of us have more than full-time jobs where we have to work overtime and things like that. I can't spend all my day focusing on the stock market. Okay, so what they do for us is they do it for us. They have professionals who work this system all day long, where they invest money into securities every day, all day. So this is a service to the investors, us, because it allows smaller investors, such as ourselves, to invest into bigger opportunities that are bigger than what our capital will allow. For example, uh, a company we want to be invested in, but a share is $1,000. For example, Amazon today, the shares are around $1,000. I can't just go and buy 5 shares. So what do? I invest $1,000 into a mutual fund that invests into Amazon, and therefore they combine all of our resources together, and they can buy 1,000 shares instantly without even being worried about it or considering it. Okay, it's just the effect of combining all of our small investor funds and allowing it to grow on a scale that we wouldn't be able to do so on our own, essentially, without having to work really hard for it. Okay, so what are we going to discuss today about mutual funds? Since now we know what a mutual fund is. Okay, we're going to discuss investor preferences, why investors prefer this investment, why do the year after year investors continue to invest in mutual funds. Then we're going to talk about results. And then we're going to talk about who is it, who is a mutual fund for. Then we're going to talk about fees. We're going to talk about the goals of the mutual fund managers, and then we're going to talk about the goals of the individual investors. Okay. So first, what are investor preferences and why do investors continue to invest in mutual funds? Okay. First and foremost, there's over $12 trillion in mutual funds today. Okay, and today, $12 trillion is a lot of money. All right. So why do the investors continue to invest in mutual funds today, even after the type of investment has been around for over 50 years? Why do they continue to choose it? And I myself continue to choose it as well. First reason why is because of consistency. Okay, any mutual fund that has been around for over 10 years, and there's a lot of them, has a track record, okay, that you can actually look at the chart, look at the graphs, look at the investment choices that they have made, look at where they made mistakes, look at where they have made positive choices, and you can look at the results over the long term. And you can consider, okay, the consistency of that term for your portfolio. You can take that consistency, that rate of growth that they have had consistently over the last 10 years or more, because there is funds that have been around longer, okay? And you can take that and use that and inform yourself even more and equip yourself with the knowledge and say, okay, this is the fund for me. Or you can even say, this is not the fund for me, because you can say, oh, look, well, one year they earned 20% and the next year they earned negative 5%. I don't like that kind of volatility. So therefore, it is not the right fund for me. Okay, and there are people, they're investors. There are millions of investors out there, and they all have different preferences. Some obviously are similar, some are not. So everybody has their own preferences, and they all need to make the choices on dependent upon their levels of risk tolerance. For example, I can be risk averse or I can be very risky. Okay, so therefore I have to choose the funds that align with my risk tolerance. Okay, so the other reason. And some firms, some funds do not have track records for a long time. So a lot of funds can be new. A lot of funds can be started today. Therefore, they won't not have a track record for the last 5 years. So they're not. But the consistency is you can find funds that have been available for a long time and have been consistent or not, and you can make your choices upon that. Or you can choose a management fund or the management company of that fund and determine upon their other investments maybe how they can perform on this one if the goals are similar or not. Or you maybe trust the management of that fund, and you can make your decisions off of that. Okay. Another reason why investors continue to prefer mutual funds is because of the regulatory environment. Okay. Regulations in the mutual fund industry is heavy, okay, and according to my research, investors prefer that, okay. Uh, According to Coran, Cerez, and Tufano, okay, the industry has exploded. Sorry, apologize for that pause. Corano, Cerez, and Tufano, the investors prefer that. So that is another reason why investors continue to prefer mutual funds. It's because they understand and they know that I can't do it all on my own. I cannot invest into stocks every day, trade stocks or trade bonds or trade anything. Okay? I cannot do that. So they rely on the government being able to regulate or set certain standards. For example, certain standards of honesty exist. I cannot go to a fund right now. Okay, obviously it's possible, but most likely it's not happening. I can go to a Vanguard website, enter my risk tolerance. I can say I'm very risk averse. I do not like risk at all. Put my level of risk tolerance at 0, and they will show me a list of mutual funds that are invested into bonds or U.S. Treasuries or other safe investments, and therefore match my risk tolerance. Okay. So because of these regulations that improve honesty from funds, the regulations that improve not consistency in performance, but consistency in honesty and consistency in integrity, and ensure that they're not overselling or overstating the documents and the performance levels. These regulations are better for investors because we know, or at least we have a more of a level of assurance that the information is true. Okay, and therefore those types of regulations help us as the investor as well, because we can know and we can sleep better and not knowing that our retirement is a little better, because we all know that we all depend on those investments and that money that's being placed into there. Okay, but a negative of investor preferences is that us investors need to understand that mutual funds are not government-backed investments such as bonds are. Okay, maybe the mutual funds are, but mutual funds in general, and it's not the mutual fund that's backed; it's the bonds within the mutual fund by the government that are backed, and they are the strictly government bonds and U.S. Treasuries. But they're not the mutual fund itself is not backed by the government. Okay, and that being backed and not being backed by the government is also uh, a call to investors to do their due diligence. Okay, according to the SEC, it states on their website loud and clear that investors must do their own due diligence. Okay, because the information is out there. We have to find it and inform ourselves. Okay, and that's part of the regulations as well. All the information has to be out there. A lot of the funds, for example, like a Vanguard Mid Cap Growth Fund, it's $35 per fund, and there's $1,000 minimum investment, and the fees we will discuss later. It says it there on the website exactly what stocks they are invested in, and therefore, if you like those stocks, you can just invest into that fund. Okay, and it won't tell you all of them until you go a little until you do a little more research, but you can find it. Okay, now what are the results of mutual funds? Okay, according to Canelo and Klein Bard, $100 invested for 30 years with a compounding and tax deferred account, okay, will turn into $6,621. Thank you to compound interest, and that is based on a 12%, which according to Sharpe will occur over time. Okay, and this is where the SEC tells you to do your due diligence because it all depends on the fund. But Sharpe and these authors defend this research, and they say that that is the case. So, by compound interest and inflation and investments and deferring those taxes in a retirement account, which we have discussed already in class, okay, though that is what you will consider getting. So that is one of the reasons why investors continue to choose this because it is continually performing well, fantastic. Because $100 turned to $6,600 in 30 years is a significant amount of returns for by any means necessary. Okay, and what kind of effects does this have on investors? Okay, according to Canelo and Kleinbard, okay, this affects our elderly terrifically. Also, according to Puterba, Venti, and Mr. Wise, it significantly improves the lives and the retirement of the elderly because they will not have to solely depend on the government Social Security, which is never really enough to survive. Okay, and they say that it significantly affected the elders and their livelihoods. Okay, this is great because we all know that we're all going to retire. So they may not be talking to the elderly of today, but but I feel like they're talking to us youth because they're telling us that you're going to be elderly one day and you need to prepare for it so that your life can be that way. Okay? And another thing is, who is mutual funds for? What kind of investor is the mutual fund for? Maybe it's not for everybody. Maybe someone prefers ETFs. Maybe somebody prefers annuities. Maybe somebody prefers strictly bonds. Maybe someone prefers strictly stocks. Maybe someone prefers U.S. Treasuries only. Who is mutual funds for? Okay, the mutual fund is not for the short-term investor. Okay, and according to Mr. Wise, mutual funds have to be held at least 10 years to see results or to notice results. Okay, according to Mr. Wise, it is only for the long-term investor. Okay. Even Vanguard suggests a 10-year investment period is standard and what it should be done because it takes around 10 years, according to Vanguard, to see the full results completely take place. Okay. Now, according to risk tolerance, it is for any risk tolerance as well. If you are a long-term investor and you have a risk-adverse mindset or a risk-adverse mentality, mutual funds are for you as well. It is also for those who are on a scale of 1 to 5, a level 2 risk tolerance as well. Even a level 5 risk tolerance or a level 4 or level 3. Why? Because they have different risk levels, risk tolerance funds out there. So if you say you want to stay completely safe, there is funds that do that. If you say you want to take complete risks, there are funds that do that. Now, are you going to take? Are you going to feel it in the earnings every year after year? Yes, because the more you risk, the more you earn. Okay, when it comes to investing in anything, the more risk, the more reward. We've learned that over the years in school, so I don't need to break that down. Okay, now what are the fees? Okay, there is a $25 fee usually with the Vanguard websites for administrative costs, such as every quarter sending you statements, sending you the updates on other investments that are in the fund, sending you so just sending you papers at all, or they're sending you emails and customer service support and things of that nature. Now they also charge a 0.07 annual fee of your investment fund total. Okay, this is per year, and it is usually charged out of the distributions or the earnings as a whole. Okay, and this fee is actually really small. There are other options out there if you don't like these sorts of fees. There are other options such as exchange traded funds, which have lower fees and are sort of similar, except exchange traded funds are traded as stocks and not mutual funds. Okay. Now, what is the goal of mutual fund managers? Okay, according to Tuteja, Banza, and Gupta, okay, the goal of the manager is two things. Now, this is very important because this is crucial to the mutual fund. Without these two things, or even one or the other, it is just not a successful mutual fund according to these authors. Okay, appreciation and dividend distribution. Those are the two crucial matters in any and every mutual funds, according to these authors. Why? Because you want to see the price of that mutual fund appreciate over time. It's not going to stay the same. Hopefully, it will rise and appreciate and not depreciate and go down. If it is a well-performing fund, it will appreciate over time, and the $35 fund that you buy today will hopefully appreciate to being $40 in the future, whether 1 year or however the fund performs. Okay. Now, second thing, dividend distributions. Now, this is where things get a little tricky with mutual funds, okay? Because as you learn about how they perform and what happens when they perform well or what happens when they perform poorly, this is crucial. Okay, so they're going to take all of the investors' money and pull it together and invest it into certain investments. Okay, and sometimes they don't make money, and sometimes they do. Most of the time, hopefully, they do. So when they do, they take that earnings. Okay, let's say they have 1 million investors, and every one of them, just for the sake of simplicity, invested $1,000. Okay, so that makes $1 billion. Okay, they make a trade, and they ended up earning, let's just say, $1 million. Let's just keep it simple. Okay, let's say they made a trade and earned $1 million. They will take that $1 million. Okay, take their profits, which may be $1 per fund or however the case may be, depending on the fund, of course. And they will pay all of their investors $1 for each fund that they have earned $1 from, or 80 cents if they charge to 20 cents. Okay, that way, $800,000 will go to the investors of the mutual fund, the owners of the mutual funds, and they will earn their $200,000. So that is how they profit and we profit, because we didn't invest it ourselves. We put it into the fund. We pull it together, and they invest it as a whole. And that is how then when those earnings are taken, they take that and they distribute a dividend distribution. They distribute them to the investors all together. Okay, and that is how the dividend distributions are earned and paid to us, the investors, if we hold mutual funds. Okay, now that is the goal of a mutual fund manager. That is extremely important to the fund manager because to attract investors like myself and like you want to see results. You don't want to be left for 5 years without a distribution because then you're going to assume that the fund performs poorly, and when other investors see that, they're not going to invest in the fund either, which is not going to is not going to appreciate the price of the fund as well. So everybody suffers when the price is not appreciated, and everyone suffers when the price when there is no dividend distribution, or at least an increasing dividend distribution or consistent dividend distribution. There is preferences depending on the investment of the investor or the fund. So what are the goals of the individual? Okay, now this is where things get a little trickier. Okay, because everyone has their different goals. So it is difficult to explain this through the research. Okay, so according to the same authors of earlier, to Tehabanzal and Gupta, okay, the goals of the investors changed with age. Now, this may not make sense at first, but it does after I did the research. It did after I did the research. Okay, first of all, when you are a young adult, okay, when you're entering the workforce, when you're starting out in life, you've obtained that first entry level position. Okay, I, for example, have already attained that, so therefore, I've already started this process. Okay, now, when you're young, the research shows that us young investors that are just starting prefer number one as the main priority returns, okay, as the main priority when analyzing any fund. Then number two, the standards of the fund. Okay, number three, training and development of the team and the management of the fund, the fees, and then lastly, okay, it is the portfolio itself that we consider. Now, this is the case because most, not everyone, this is just most, and in my case, it is the case, we prefer strictly greater returns and we tend to not care about anything else because we typically have little bit or no money, so we want to start seeing money there, so we would like or prefer our investments to grow at a much faster rate, and we tend to not pay attention to the risk because that's really all we see, and we say, oh yeah, pay attention. At least it's my case. The first thing I always look for in a fund is how much did it earn last year, how much did it earn in the last 3 years, how much did it earn in the last 10 years, instead of saying, hey, this is the well-managed fund. No, I usually look first solely at the returns over the last 10 years, but first the last year as well. Because for me, it is extremely important, but according to the authors, it is usually the case with the 140 people that they interviewed. This is usually the case for the younger generation. Then at the older generation, when investors are already established, and obviously I can't testify to this because I'm not there, they tend to not put returns first. They actually put returns way later in the ladder, in the categories. Okay, the first priority of the established investor who is nearing retirement is the portfolio in total. Okay, then the next thing after that is the training and development, and then the fees, and then the returns. We can see the difference in priority because they're focused on their money not depreciating instead of looking for radical appreciation. So when we start out, we typically look for radical appreciation so that our little funds can skyrocket into a greater fund. But once you are established and almost nearing retirement, you tend to usually have money already saved. And you've already earned it, and you've already compounded, hopefully, and you've already done very well for yourself, hopefully. So your priorities tend to change. So returns aren't a number one priority anymore. What is the priority? The management, the portfolio, the what you can depend on what will happen tomorrow on the fund. You do not, as an established investor, you do not want to deal with volatility in the stock market because you do not want to lose your money because you want your money for sooner rather than later. When you're investing long term, you don't mind the volatility because you expect over time it will go up and appreciate and compound and do greater things. Okay, but when you're already established, those are not your priorities anymore. And that was what the research of Tuteja Banzal and Gupta found over their studies of 140 different investors, and young and old. And that was an interesting piece of finding because it actually does speak. I feel it speaks the truth, but obviously it's not the case for every investor because you will always find young investors who are risk adverse, and you will always find an older investor who is not risk adverse and is willing to take all the risk in the world. So it depends on the investor and his preference, but obviously this is the research done by them. Okay, so let's recap what we have discussed. Okay, so we know that mutual funds are SEC registered open investing company that pulls money from many investors and invest into the marketable securities for us. It's pretty much as having a financial advisor within a fund. Okay, obviously that's not literal. It's just an example. Okay, we know that over $12 trillion is in the mutual fund industry. Okay, we know why investors prefer mutual funds, and that is because of the consistency, the regulatory environment, and we also know a con of we know also the track record, and we also know not only the pros of the mutual fund, but the cons of it is not government backed, which is understandable because every other investment isn't government backed except for U.S. government specific investments. Okay, so what is the results of mutual funds that keeps pulling investors in? Remember, we spoke about this. It was the results. It was the positive effect that it can have on the elderly. For example, on myself, and it says Cornell and Kleinberg, the author, stated that every $100 that I invest today will become over $6,000 in 30 years, which is a tremendous amount of returns, which most likely you won't get anywhere else. Okay, obviously there is, but you know what I'm saying. Okay, according to Sharpe, the author states that a 12% return over the long term per year is expected. Okay, who is the mutual fund intended for? It is intended for, remember, the long term investor. And even Vanguard suggested 10 years minimum should be your goal. Okay, and remember that mutual funds have different risk levels for every single fund. So there is a fund for you and there is a fund for me. We just have to find it. Okay, or your financial advisor can find it for you. Okay, there is fees of a 0.07 annually on the one example that I have found with the Vanguard mid cap it was a large cap growth fund, okay, intended for higher risk levels and higher risk tolerant investors. Okay, and the fee was 0.07%, which can be which is not a large, but it should be considered, and with a $25 administrative annual fee. Okay, and remember, what is the goal of the mutual fund manager? Okay, the mutual fund manager has a simple goal of capital appreciation and dividend distribution. Remember, this is crucial because I, as an investor, will look into the history of the fund, and you will too, and you will see the track record. So therefore, every investor wants to see two things: capital appreciation, dividend distribution, because you want to know what will happen in the future. Obviously, it was not a guarantee, but a well-run fund will typically continue to perform well. Now, how do you take those distributions? Okay, remember they will pay you either quarterly or annually. And just to add this, they will pay you as either cash or in reinvestment into the fund. So this is a great alternative for those who are extremely long term, like myself, who have just entered the workforce, which means in the next 40 years, every distribution that they have paid me will actually go right back into the fund. So they will have actually buy me more funds with the original funds that I have deposited and the ones that they have earned and I have earned through the investment will go right back into the fund and earn me more interest, hopefully. Okay, remember the goal of individuals change with their age. Okay, this is not specifically 100% accurate with every young investor and with every older investor, but it is a broader picture of, I feel, what is really going on and what I am seeing with my colleagues. Okay, when they're younger, we tend to care about riskier investments that earn more or have the potential to earn more and greater over the short term and long term, preferably short term because over time our investments will change. Okay, and when you get older and more established and you already have that established retirement amount or account, the portfolio as a whole tends to be more important. The management level of care, the training and development, the customer service tend to come before the returns and the fees. Why? Because you already have the substantial amount, so you don't mind paying a little more in fees to protect what you already have, and you don't want to go to a more riskier investment and risk losing all of your funds. You would rather be safer to ensure the longevity of your funds so that you can retire more. You can enjoy life more in retirement. Okay, so we have learned all of these things. I hope that that we have learned something together, and I also hope that you will consider mutual funds. Now, disclaimer: there is a lot of great investments out there. There are exchange traded funds, there are annuities, there are different types of investments, and they all are. Most of them are all great, if not all. That is something that we all, like the SEC states, Securities and Exchange Commission states, we all must do our own due diligence, and we all must make sure to do our research and make sure to do our due diligence so that we can make the best choice possible. After all, my retirement depends on it, your retirement depends on it, our retirement depends on it. We do not want to grow and not have enough money, but instead we want to be like Mr. Kleinberg states, and in our elderly years, it will have a positive impact. We do not want to be in our elderly years wishing we had invested. So thank you for taking your time to watch this video with me, and I hope you enjoyed it, and I just want to thank you and have a great day.